The world has been rattled by an epoch-making crisis, which has caused significant harm, shuttered businesses, put livelihoods at risk, and protectionist reactions have cast doubts about the future of globalization. As we start rebuilding, we need to seize this opportunity to build a better tomorrow, one which achieves a more balanced, fair, and ultimately a more sustainable world. Globalization has helped raise living standards around the world in recent decades, and will continue to be vital for the future. Finance will continue to play a central role in international business. Making sure capital is available when needed will be crucial in shaping the global post-COVID economic recovery. Investors will provide the funds required to help companies around the world stimulate growth and create jobs. They will also help bring about the transition of our economies to a more sustainable future. Luxembourg will play its part. Our unique expertise in international finance connects investors with projects. Our ecosystem, our toolbox of investment vehicles, and our stability offer an ideal platform for financial services to operate on a worldwide scale. Luxembourg contributes to building a better, stronger, more open, and more sustainable tomorrow.
Welcome to the Sustainable Finance Forum, bringing together key sustainable finance experts from across the world to share their views on how finance can shape a sustainable future.
Ladies and gentlemen, good morning, good afternoon, and good evening. Wherever you are in the world, a warm welcome to this fourth edition of the Sustainable Finance Forum. My name is Judith Bogner, and once again, I'm honored and delighted to lead you through the conference on behalf of Luxembourg for Finance. So today and tomorrow we'll be broadcasting live from our studio here in the European Broadcasting Center in the heart of Luxembourg. And of course, first up, I'd like to express our gratitude to all those 21 speakers and moderators who set aside time to join us and share their insights on sustainable finance. Our gratitude also goes out to our media partner and our sponsors for their support and collaboration. And we thank all of you who are joining us from more than 60 countries with some 1,000 participants. And of course, we welcome that you tweet about the conference and post on LinkedIn. And if you do so, please be sure to add the hashtag SFFL21 and the handle @LuxFinance so we can all see what you share. And as always, everything will be recorded and the stream will be made available after the event right here where you are on the Luxembourg for Finance website. Now, this event could not come at a better time. This weekend, COP26 will kick off and finance will be center stage. Having covered sustainable finance for more than 10 years now, my observation is this. We are quite clear about the direction we are going into, but this landscape we are moving into is literally changing under our very feet. The green taxonomy, which came into force last year, has set out a common language on green investment, but certain aspects still need to be clarified. For example, how do we label natural gas or nuclear energy? And then the disclosure regulation, SFRD, and the new corporate sustainability reporting directive also still are being fine-tuned. And at the same time, the EU Sustainable Finance Platform is working on further regulatory designs, for example, pertaining to social aspects, to biodiversity, and much more. And as we will hear today and tomorrow, all these innovations are already changing strategic decision-making, product innovation, data analytics, and much, much more. That said, 6 years after Paris, despite this innovation, despite the task forces and alliances and commitments, we continue to see a rise in subsidies and also investments into fossil fuels, and emissions continue to rise. Just to give you an idea and put that in perspective, According to a new paper by the IMF, global fossil fuel subsidies stood at $5.9 trillion last year. That's about 6.8% of GDP, and that is expected to rise by 2025 to 7.4% of global GDP, which is in part down to a rise in consumption and fuel consumption in the emerging markets. So all this runs counter to the logic of the recent IPCC report, Code Red for Humanity, which clearly lays out what awaits us if we fail to limit global warming to 1.5 degrees. And the ECB, the European Central Bank, has also been sounding the alarm. After conducting an economy-wide climate stress test, it concluded, and I quote, that climate change will be a major source of systemic risk for the banking sector if no action is taken. And so, to quote Dr. Fatih Birol of the International Energy Agency, he said the gap between rhetoric and action needs to close if we are to have a fighting chance of reaching net zero by 2050. So today and tomorrow, we'll talk a lot about what I call the 3 C's: coordination, cooperation, and capital, that need to underpin all those commitments to protect the climate, to protect biodiversity, and to build back better after the pandemic. And staying with C as in capital, we all know that green bonds certainly went from strength to strength, and we'll hear about that tomorrow in our investment panel. In the last couple of weeks, the European Union in particular made history in that regard by issuing its first ever green bond, 12 billion euros. It was listed here on the Luxembourg Green Exchange, and it attracted the largest ever green order book to the tune of 135 billion euros. And that is just the first slice of the next generation EU green bonds program, which could reach up to 250 billion euros by 2026, and of course is likely to make the European Union the largest green bond issuer on the planet. So to give us more perspective about building a sustainable European and indeed global economy, I have the great pleasure to welcome to the Sustainable Finance Forum now the EU Commissioner for Financial Services, Financial Stability and the Capital Markets Union, Mairead McGuinness. Warm welcome to you, Commissioner, and the floor is yours.
Well, good morning, good evening, and good afternoon. And can I thank you, Judith, for compressing the state of play in relation to the challenges that lie ahead for the planet and indeed for the financial sector. And I'm really happy to have this opportunity to talk to you about the European Union's plans for financing a sustainable economy. And a big thank you to Luxembourg for Finance for this invitation. But of course, Luxembourg and its financial industry are pioneers in this area. And to recall that the Luxembourg Stock Exchange listed the first ever green bond to enter the market back in 2007. And that was the European Investment Bank's Climate Awareness Bond. We have come a long way since 2007. I think by now, particularly this year after the pandemic, everyone recognizes the severity of the climate crisis and the urgent need to act, as you put it, Judith, to move from rhetoric to action. And of course, with COP26 starting in August, or rather in Glasgow this Sunday, sustainability is very much front and center for industry and policymakers right across the globe. And we have to keep it there to make sure it stays front and center. As of today, the European Union is a leader in sustainable finance. Leading is very important, but we want all countries to step up so that globally there is coherence and determination. So with you this morning, I want to share how we got to the point we are, where we need to go next, and how to bring others with us on this journey. Because at the end of the day, the European Union cannot tackle the climate crisis by acting alone. So the European Union is committed to reaching net zero by 2050, and we need to reduce greenhouse gas emissions by at least 55% by 2030, less than 9 years. So it's very, very imminent. To make this happen, a huge amount of investment is needed. Decarbonising power generation, industry and transport, improving the energy efficiency of buildings. And these are all important steps in reducing dependence on fossil fuels and increasing our energy security. Some figures now. We need to invest around 350 billion euros extra every year in the energy system alone to meet our 2030 emissions target. And in addition, so on top of that figure, we need around 130 billion euros for other environmental goals. And I think those figures give you a sense of the scale of additional finance required just in Europe alone. So globally, to limit the temperature increase to under 1.5 degrees, the world needs to invest the equivalent of around 2.5% of GDP in the energy system alone each year from now up to 2035. And these are very cold, hard numbers that are needed to tackle the climate crisis because change will not come without investment. And public money, of course, is needed, but private investment is key. Over the last few years, we've seen floods, heat waves, droughts, and wildfires, and they've turned the lives of people upside down, and indeed many have lost their lives. And the sad truth is that these extreme weather events are becoming more common at huge cost to people and communities. And if we want to protect the planet for generations to come, we need to accelerate fundamentally the transformation of the economy, both in the European Union and at the global level. And I have said already about public money being important, but of course the scale of the investment required goes way beyond what the public sector can provide. And therefore we need the financial system to drive the transformation, and we need private money to flow towards businesses and projects that can transform the economy for the better. And in the private sector, we need sustainability to be more than just a nice to have. It is a must-have. So that's a very big change in mindset, as well as in planning and organisation that is required. I believe the investor appetite is there and it's growing. Industry is increasingly on board. In the first 5 months of this year, investors financed ESG bond funds to the tune of $54 billion, well on the way to overtaking last year's record, which was around $68 billion. So now is the time for policymakers to deliver credible tools and clear rules to help take the financial sector, and by extension, the entire wider economy, where it needs to go. So where are we going? Last year, or rather, if you look at what we've done this year, before I preempt, in July of last year, the Commission stepped up a gear our work on sustainable finance with a renewed sustainable finance strategy. Given the urgency of the challenge and the barriers to change, we wanted to put a clear plan in place for the financing of the transition to a sustainable economy that leaves no one behind. And this ambitious strategy is an opportunity to not only green our financial system, but also to give everyone, from citizens to small businesses to big banks, a decisive role in the European Green Deal and achieving climate neutrality by 2050. And while I've managed so far not to mention COVID-19, I think it's important to reflect that the virus is still with us and economies are still in the early stages of recovery. And I think our bigger strategy will help ensure that the recovery supports the green transition. So there is nobody suggesting that we should go back to the status quo. I think the focus politically is on perhaps using the experience of the pandemic to propel us to a better, more sustainable future. The number one priority is making sure businesses and projects that do good for the planet and for people get the financing they need. And this starts with making sure that we are all on the same page about what is green. And that's where the EU taxonomy comes in. The taxonomy is a classification system that clearly signals which economic activities are sustainable. And the taxonomy allows companies to give clear signals to investors on the path, if you like, the steps they're taking to become more sustainable. And it can help them plan the transition with clear parameters and to shift investments to where they're most needed. The taxonomy can be used to develop other sustainable finance tools like disclosure frameworks, making sure that sustainable finance rules are coherent. The EU Green Bond Standard will be based on the taxonomy. And this is a voluntary standard that will be available to all green bond issuers, including sovereigns and corporates, to signal their strong environmental commitment. Issuers will be able to demonstrate and investors will be able to verify that they are funding sustainable projects aligned with the EU taxonomy. And of course, our taxonomy is also an important tool to prevent greenwashing in our financial system, because this would be a big concern. To fully address the risks of greenwashing, we have also proposed new disclosure requirements for companies and investors to increase transparency and help end investors identify credible investment opportunities. And this is the basis of our Corporate Sustainability Reporting Directive proposal. This proposal will strengthen the EU's corporate sustainability reporting rules and provide companies with a rational and cost-effective solution for reporting. Because if we look at the current situation, there are multiple standards and expectations, and this is confusing, costly, and inefficient. But the effectiveness of our sustainable finance policies will depend on how well they are enforced across the European Union. And here supervisors have a key role to play in monitoring compliance with new regulations. Supervisors must make sure that their legal mandates and power to protect investors and consumers against unsubstantiated sustainability claims are used. So checking and verification are absolutely key. Greenwashing risks will need to be monitored closely, and where necessary, action must be taken. Supervision and enforcement must be consistent, as I've said, right across the European Union. Now, to make sure that this is the case, the Commission will assess the current supervisory and enforcement toolkit that is available to competent authorities to protect investors from those risks. As I said at the outset of my address, the European Union cannot tackle the climate crisis by acting alone. And therefore, we are strong promoters of both convergence and ambition when it comes to sustainable finance at the international level. Tools and metrics for the private sector, like taxonomies, must be compatible at the global level if we are serious about real change. Today, the European Union leads the International Platform on Sustainable Finance, which brings together representatives from over half of the world's GDP, population, and emissions. And the work of the International Platform feeds into the work of the G20. For example, it's provided the G20 Sustainable Finance Working Group with an input paper setting out principles and recommendations for improving the comparability and compatibility of different global approaches. The International Platform on Sustainable Finance will continue working to align taxonomies globally, which will encourage cross-border investment towards these shared sustainability goals and reduce due diligence costs for investors. The platform is due to publish a report very soon on a common ground taxonomy, which will set out the common features in existing taxonomies developed by public authorities. And that's not all. The Commission is also active in other international forums. For example, we are working with the Financial Stability Board to develop ambitious standards and principles for disclosure and to advocate for comprehensive sustainability reporting standards. Not all countries are starting their journey towards sustainability in the same place. Using support measures available under the outward-looking part of the European Green Deal, the Commission will help accelerate private financial flows across our partner countries. And we'll also use our existing policies, such as the Neighbourhood Development and International Cooperation Instrument, Global Europe, and the Instrument for Pre-Accession Assistance to support efforts by partner countries to scale up sustainable finance. So to conclude, there are challenges ahead, but today I am cautiously optimistic about the future, because I do believe if we act now, we have the chance to turn things around. Of course, if we don't act, we all know the dark consequences. So I speak in this cautiously optimistic frame. I'm glad to see a growing number of financial institutions making voluntary pledges on their transition plans to reach net zero at the portfolio and indeed at the entity level. And here the European Union is ready to support. The taxonomy and other sustainable finance tools provide a guide for the transition to climate neutrality. Underpinning your voluntary pledges with EU regulatory tools will strengthen the coherence, clarity, and credibility of these pledges and ultimately increase their chances of success. Transparent targets and decarbonisation pathways are crucial for the successful transition of the financial system and the real economy. Today, in the member state I know best, front pages are talking about carbon budgets. So they are now top of the agenda in member states and globally. So my message is, let's work hard, let's work fast, and let's work together to finance a sustainable economy for the generations to come. Thank you all for your attention, and back to you, Judith.
Thank you so much, Commissioner, for your rallying call. Duly noted. It's time to take action. And now, in keep with a tradition at the Sustainable Finance Forum, it's my great pleasure and honor to welcome to the digital stage, as it were, the CEO of Luxembourg for Finance, Nicolas Mackel, and Luxembourg's very own Finance Minister, Pierre Gramegna. Over to you, Nicolas.
Well, good morning, everyone, and thank you very much, Judith, for this very kind introduction. I would also, of course, like to thank Commissioner McGuinness for her speech. We certainly appreciate her taking the time to join us this morning. And, of course, as the organizer, I would love to express also my words of gratitude to our audience who are joining us, not only very numerous, but also from many different countries on this year's edition of the Luxembourg Sustainable Finance Forum. Obviously, I also thank our sponsors in helping us with their support for this event. This event comes at a crucial moment, a couple of days short of the COP26 that is taking place in Glasgow. And to discuss this and some other issues, I welcome Minister of Finance Pierre Gramegna. Thank you for taking the time from your busy agenda.
Thank you for having me. It's a pleasure to be participating to this fourth edition of Luxembourg Sustainable Finance.
Indeed, thank you very much. You are one of the few ministers of finance who are actually physically traveling to Glasgow next week to attend the COP26. What are your expectations for this meeting, and what is it that you actually hope for there?
Well, it is true that I will participate in presence to the COP26 in Glasgow upon invitation of the Finance Minister of the United Kingdom, Rishi Sunak. Only 10 ministers will be there in presence due to the hybrid format, which tells us that we haven't overcome the pandemic yet completely. So let's hope that soon it's going to be the case that we can again do this forum, which is so close to my heart in physical presence here in Luxembourg. What we expect at COP26 is further commitment of all participants. And let's face it, the pandemic has underlined the emergency of the climate crisis. We keep on all talking about climate change, but the climate change is happening in front of our eyes, and we have to solve the climate crisis as soon as possible. So, all commitments that were already taken should be really delivered. I mean, all countries permanently realize that the developed countries should contribute 100 billion to the less developed countries in order to help them overcome the climate crisis. Only 80% of these 100 billion have been done and promised and delivered, so there's still a gap there that all countries have to fill. In fact, I must say that that was the first thing that the climate representative of President Biden, John Kerry, told me when I met him in Paris in the margins of the OECD ministerial meeting. And I'm pretty confident that something is going to happen in Glasgow on that item. I just mentioned the United States. Let's face it, it's really good news that the American government has decided to participate again to the COP26, but also to rejoin all the countries in the Paris Accord for climate change. It gives credibility to this goal to the whole climate. And let's also face the fact that China has committed itself to go towards zero net emissions at the latest for 2060, as has also announced very recently Saudi Arabia. So it shows that all the countries around the planet, amongst them larger emitters, are doing so. So that's good news, and I think paves the way for a lot of hope. And the hope is all the more necessary because the pandemic has shown that the climate skeptics were wrong, because during the lockdowns that we had last year, we saw that the planet was doing far better. So we need to act quickly.
Good. Europe has, of course, and Commissioner McGuinness has reminded us of this, been a pioneer in setting up a regulatory framework for sustainable finance through the taxonomy and through the different disclosure requirements. How do you see the taxonomy playing out on a global scale? Europe has created a very deep and precise regulatory framework. The US doesn't seem to be moving into that direction. How is this playing out on the international level? Commissioner McGuinness has been talking about the work that the European Commission is doing with the international platform on sustainable finance that is feeding into the work of the G20. How do we avoid fragmentation of the markets?
Well, this is a very important topic, because what we all want is to avoid greenwashing. When we're setting standards to make sure that what we do in favor of the climate is real, we are just trying not to lie to ourselves. If we just paint everything in green, we will not help the health of the planet. So this is a very serious topic. Europe, as you rightly said, Nicolas, is ahead of the game, because the taxonomy has been already agreed 1 year ago. Lots of delegated acts are following. But let's face it, Europe will not be able to just impose its taxonomy to the rest of the world. In fact, you and I were in the United States last week, and we heard from American actors from the financial services world that they prefer a bottom-up regulation instead of top-down. And in fact, one doesn't need to be someone who reads the future to realize that what will happen is something that will be in the middle of all of that. So we need to take all countries on board. One of the initiatives is the one that the Commission has taken with its platform, but I guess that eventually we could build on the expertise that the OECD has developed in recent years in many topics. In fact, the OECD has shown in the transformation of the international landscape of taxation that it can basically broker a framework, an agreement at the level of the whole planet. So at the last OECD meeting, the Secretary-General Coleman suggested that we try to make all the initiatives in terms of standards comparable, interoperable, coherent, transparent. I would really militate for that. It is key, because it will help us pave the way to compare notes and see if we're really committed all together, and that we compare not apples with pears, but just the same coherent standards.
I think the financial industry would also want to have a convergence among standards to avoid having to set up different products in different markets to conform to them. Now, if I may turn to another point, many voices have been heard over the last month criticizing the slow pace of progress in sustainable finance, whether in sustainable finance in general or in Luxembourg in particular. What is your answer to these critics?
While one can always see a bottle half empty or half full, I see a lot of optimism in the developments of the last year. Take, for example, green or sustainable bonds. It took 14 years to reach a level of $1 trillion of such bonds. And it seems that this year alone, in 2021, there's going to be 1 trillion additional sustainable bonds that are going to be emitted. So we do in 1 year what we used to do in 14 years. Obviously, it's still not enough, but Europe is really leading the pack. A couple of days ago, the European Commission just listed its first major green bond at the Luxembourg Green Exchange, and it was the highest green bond ever emitted, 12 billion euro. Last week also the Commission listed a social bond worth 5 billion euros. So you see that sustainable finance is becoming much more important, and especially the European Union there is a key driver. In fact, it is one of our major answers to the pandemic. We want to relaunch Europe with the Next Generation EU and the Recovery Fund, and we do so by focusing mostly on green investment, on climate change related investment. If I take the case of Luxembourg, in our recovery plan, the issues of green and climate make up even 60% of the investment. So that's what I would say, the half bottle that's full. Let's face it, what is being done is still not enough, and we need to have more countries doing more, and we need also, as I said in the beginning, embark on the same ship, all the least developed countries, developing countries, and emerging countries. We can do that, for example, by blended finance. We have innovated in that in Luxembourg as we launched a climate finance platform with European Investment Bank, and with an initial investment of 150 million euro, we have been able to trigger and leverage investments worth more than 3 billion euro. How do we do that? By taking the first loss as a country, so de-risking projects and making projects bankable that otherwise wouldn't be. So it's not only support and subsidies, it's also blended finance that will help us reach the goals.
Well, I think many countries, as you said, should step up the game and start initiatives like the ones you have mentioned, because probably, as you rightly said, we are still only at the very beginning of this process of financing the transition towards net zero in 2050. Thank you very much, Pierre Gramegna, Luxembourg's finance minister, for sharing your candid but still very optimistic views on this. Ladies and gentlemen, let me now turn to the next segment in our program, where we will be joined by William Wright, the founder and managing director of New Financial, a London-based think tank. We approached William and his team a couple of months ago and suggested that they work for us in partnership on looking at really X-raying the state of sustainable finance throughout the different sectors of the financial industry. And we will publish, on the occasion of this forum today, a report done by New Financial showing where exactly sustainable finance is. Now, I let William show you the numbers. We look at this also as something that it would be good to do on a regular basis to see the progress. As the Minister has said, we are only at the beginning of a process, and we need to see how we are making progress, which was the title of our discussion this morning. But I think what will be very clear coming from these numbers is that the pace needs to pick up. William, over to you.
Good morning, good afternoon, and good evening, ladies and gentlemen. Thank you for that kind introduction, Nicolas, and for the invitation to join you today at the Sustainable Finance Forum. And above all, thank you to Luxembourg for Finance for partnering with New Financial on this important project on benchmarking ESG. My name is William Wright. I'm the founder and managing director of New Financial, a think tank that makes the case for bigger and crucially better capital markets in Europe. Today, I'm going to present some of the brief highlights of our latest report that we're publishing today on benchmarking ESG in banking and finance. With COP26 starting this weekend, the aim of the report is to cut through all of the noise around ESG and bring together in one place more than 60 metrics to analyze the size, growth, and penetration of ESG and sustainable finance in different sectors of banking and finance around the world. The report provides a comprehensive cross-sector benchmark for comparing ESG activity in different sectors and different regions, and for measuring future growth. So there are 5 key themes that I want to quickly run through today from the report. The first is the level of public commitment to ESG across the banking and finance industry. Second, we'll briefly look at the rapid growth in different sectors of ESG activity. Third, we'll put those two together and we'll measure the penetration of ESG activity in different sectors, which for all the noise is perhaps still surprisingly low. Fourth, to highlight the multi-trillion-dollar question as to whether or not the growth in ESG activity is ultimately achieving the aim of channeling more finance, more investment into companies that can help address the climate emergency and help build a more sustainable economy. And finally, a few metrics which underline, if you didn't know already, that implementing ESG, converting commitment, PR, and new product launches into concrete action is perhaps a lot harder than it looks. So let's start with the public commitment to ESG across the banking and finance industry. As you all know, there are hundreds of well-intended, well-meaning ESG initiatives around the world, and many firms have proudly signed up to them. We see this as the first step that any firm serious about ESG and sustainable finance would take, because it's effectively cost-free. What we found was that while the public commitment across different sectors was high, it's far from universal. We built a sample of the largest firms in the world using lists like the Banker's Top 1,000 Banks or the Willis Towers Watson Top 500 Asset Managers. And then we matched those firms to the signatory lists of the main ESG initiatives. And this chart shows the percentage of large firms that are signatories to at least one of these main initiatives. The grey bars show global signatories, and the blue lines show the penetration and public commitment of large European firms. There's a very wide range in the public commitment. For example, around 3/4 of the top 500 asset managers in the world are signatories, but just over 1/4 of the top 1,000 banks have signed up to one or more of these main ESG initiatives. And as you can see, a higher proportion of large European firms have publicly committed to ESG initiatives than the global average in every single sector. Overall, just over 40% of the 2,300 largest firms in the world that we looked at have publicly committed to ESG, while roughly 2/3 of the largest European firms have done so. Let's look briefly at the rapid growth in ESG activity around the world over the past 5 years, including all ESG bond issuance, corporate ESG bonds, sustainability-linked loans, and the assets of ESG investment funds. If you half close your eyes when you're looking at this slide, what you can see is that the trend is fairly constant, and that on average, ESG activity has increased 5-fold from 2016 to 2020. For example, global ESG corporate bond issuance has gone from just over $100 billion in 2016 to nearly $570 billion last year. And the value of ESG investment funds is now nudging $2 trillion. Activity has continued to grow in 2021, as Commissioner McGuinness and Minister Gramegna have just noted, particularly in the bond and loan markets. Now, this growth is, of course, welcome, but it translates into a surprisingly low level of overall activity. We are, as Nicolas has just said, very much at the beginning of this process. This chart shows designated ESG activity as a proportion of all activity in different sectors at a global level, the grey bars, and at an EU or European level, the blue bars. Now, two things really stand out for me. Firstly, that at a global level, ESG only represents between 4 and 6% of all activity in those sectors where you can clearly measure designated ESG activity. The second point that stands out for me is that the EU and Europe are well ahead of the rest of the world, with ESG representing roughly 10 to 20% of activity in designated sectors. This penetration is 3 to 4 times higher than the global average. And in many cases, the US, the UK, and Asia Pacific are 4 to 5 years behind Europe and the EU when it comes to the level of penetration of ESG activity. Now, of course, that's only the sectors where designated ESG activity actually exists. But as we know, not all sectors in banking and finance have any clear designated ESG activity at all, including equity markets, bank lending, and large parts of retail financial services. So even these relatively low penetration figures, we think, overstate the true picture. One way of looking at the real level of penetration of ESG is to look at the sort of companies that are using the capital markets to raise money. So we created 2 baskets of companies, and we measured what share of global capital markets activity they represented in the corporate bond, equity, and loan markets in the 5 years from 2016 to 2020. The first bucket, the blue bars, are what we call good ESG companies. These are companies whose primary activity is addressing environmental and social issues, such as a renewable energy or a recycling firm. The second bucket, the grey bars, are what we call bad ESG companies. This is a mix of companies with a severe ESG risk rating, companies on the Climate Action 100 Plus list, or companies in the oil, gas, and mining sector. And it's pretty clear that across the global capital markets, good ESG companies account for a tiny proportion of overall activity, just 2% on average, although there are some indications that over the past 5 years, that share has been growing. While bad ESG companies accounted for roughly 20% of all activity globally in capital markets. In other words, for every dollar raised by a renewable energy company trying to solve this problem, roughly $10 are raised by the sort of companies most responsible for causing and perpetuating the problem itself. Now, this analysis is obviously quite simplistic. In part, it just represents the different size and maturity of these sectors. But we think it raises valid questions around whether the rapid growth in ESG activity is ultimately channeling more investment into green companies trying to address climate change, and ultimately whether ESG is achieving its aim. Finally, a few metrics on how translating public commitment into to ESG into concrete action is a lot harder than signing up to a few ESG initiatives or launching some new ESG products. First, the top chart here, we looked at a sample of the largest 120 asset managers, asset owners, banks, and insurance firms around the world. And we found that just a third of them have published a clear engagement strategy for their portfolio companies on climate reporting and climate targets. Even in Europe, just half of the largest firms in our sample had done so. Second, the middle chart, we looked at the compliance rates with the 10 main recommendations of the TCFD. And we found that as of 2020, the average compliance rate for asset owners was 47%. And for asset managers, just 41%, although in both cases that compliance rate is increasing. It's interesting to note that when you look at the compliance rates on setting targets and metrics, it was in the high teens to low 20s for both asset owners and asset managers. And finally, linking back to the previous slide on good and bad ESG capital markets activity, a few data points in the bottom chart. We drilled down into this capital raising activity and we found that in the EU, bad ESG companies account for 34% of all corporate bond issuance, which doesn't sound so good. At the same time, these companies account for 43% of all ESG and green bond issuance in the EU, which sounds positive in that they're using the bond market to help do something about the problem and that the demand from investors is clearly there. But ESG bonds only account for around 10% of the bond issuance by these bad ESG companies. In other words, 90% of their capital raising is not from ESG bonds, which rather helps put the size, growth, and penetration of ESG activity into some perspective. So that's a very brief run through of some of the key findings in this report on benchmarking ESG. There's a lot more detail, a lot more narrative in the report around the opportunities, challenges, and risks ahead for the industry and for regulators and governments. At New Financial, we look forward to continuing to monitor the progress and penetration of ESG in future. And I look forward to the discussions at the rest of the event today and tomorrow. But in the meantime, thank you for your time and back to Judith in the studio.
Thank you very much, William Wright, there from New Financial. With a reality check, as we just heard, translating those commitments to protecting the climate and in sustainability in general is harder than it looks. So William gave us this reality check regarding volumes pertaining to sustainable finance investment flows. And the next question is, of course, which investment trends are investors attracted to? And that's the task for our next panel, our first panel of this conference. And as moderator for this panel, I have the pleasure to introduce to you a familiar face for the audience of the Sustainable Finance Forum. She's right here with me in the studio next to me, Denise Voss. Warm welcome. Denise is a non-executive director of investment funds and has worked in the financial industry in Luxembourg since 1990 and 25 years of that with Franklin Templeton. Between 2015 and 2019, she was the chairwoman of the Association of the Luxembourg Fund Industry. And since 2019, she's the chairwoman of what we know in Luxembourg as LUXFLAG. And I'll unpick that for you. That's the Luxembourg Fund Labeling Agency, which has, of course, pioneered the concept of fund labeling to provide investors with that much needed clarity on their sustainability investments. And I should add that Denise also leads the Invest Education platform, which teaches the next generation of asset managers about finance as a force for good. So, warm welcome to you and the panel, Denise, and the floor is yours.
Thank you, Judith, for that kind introduction, and welcome to you all. I'm very pleased to be moderating the first panel of today, focusing on global trends in sustainable finance investment. As we heard earlier today, we are on a journey, a sustainable finance journey, and a journey to make all finance sustainable. Financial market participants, though, are on different stages of that journey, and sometimes that journey feels like it's happening at light speed because of what's at stake. So I'm very pleased today to introduce three well-known industry experts who will talk about that sustainable finance journey, as well as, in particular, global sustainable finance investment trends. So with us today in Luxembourg is Julie Becker, CEO of the Luxembourg Stock Exchange. From London, we have Dr. Michael A. Ridley, who is head of global head of responsible investment for HSBC Asset Management. And from Singapore, we have Jenn-Hui, who is global head of stewardship and sustainable investment for Fidelity International. So I'd like to start with a roundtable where each of our panelists will spend a few minutes talking about one top global investment trend when it comes to sustainable finance. And I'd like to ask Julie to start. Thank you, Julie.
Thank you very much, Denise. Good morning, all, and thank you to LFF for inviting me to take part to this panel discussion. So sustainable finance trend, what is the most important trend for us today? Well, because Luxembourg Stock Exchange is the world's leading platform in listing international debt securities, let me focus on the debt market and the sustainable debt market, which overall has grown exponentially since 2007, and the first climate awareness bond or green bond that has been issued by EIB and displayed on the green platform. Since then, as the Minister of Finance explained, we needed 12 years to reach the first trillion of cumulative sustainable debt issuances. And in 2021, based on Bloomberg estimates, we may reach the first trillion of new sustainable debt issuances in only 1 year. So 1 trillion in 1 year, which is quite exceptional. And even if you rightly mentioned that, well, the growth of sustainable finance is not quick enough, the pace of change is clearly accelerating. And for that, I think that post-COVID as well, in the investor communities, there's a new sense of urgency to transition to a low carbon and a more inclusive economy. And for that, investors' demand is greater than the supply of sustainable finance products. And that's why this has led to more innovation in the sustainable finance industry. And we see new innovative sustainable finance products emerging. Let's take, for instance, the sustainability-linked bond, or SLBs, which are bonds that are issued by companies which commit to future improvements in sustainable outcome by a set date. So they have to disclose their sustainability strategy and set measurable and ambitious science-based targets in sustainability outcome. But what is really interesting here is that it concerns any companies in all sectors. So it helps them really, especially hard to abate sector, to accelerate their transition. The interest here is clearly to broaden the scope of the sustainable finance product, and so the scope also of the sustainable investment universe for investors. Same thing for climate-aligned issuers bonds. So we expanded also our platform to that kind of bonds, where here the product innovation is not related to the product itself, because the companies that are issuing that type of bond and are considered as climate-aligned are companies that derive at least 75% of their revenue from climate-aligned activities like low-carbon transportation or clean energy. But here, the goal is really to highlight untapped investment opportunity in the broader sustainable investment universe beyond labeled bond to really address the lack of supply. So to conclude, these developments are important for 3 reasons. Because first, the greening of economy takes more than green bond only. Second, climate-aligned issued bonds help reorient capital flows towards companies that are considered as climate-aligned and bringing an impact in terms of green or social aspects. And finally, to speed up the transition, we really need all sectors to transition and to transform into sustainable models.
Great. Thank you very much, Julie. So obviously innovation, a clear trend, not just in about processes and technologies to help with the climate crisis, but also, very importantly, the innovation in financial products and financial services even, I guess you could say. Good news, since obviously, since what is at stake is it requires a lot of investment, of course. So now, Michael, what for you, what is a top investment trend in sustainable finance? Thank you.
Thank you so much, Denise, and thank you so much to Luxembourg for Finance. It's great to be here representing HSBC Asset Management. So I was going to talk about two trends. The first one is the green bond market. We're a big supporter of the growth that we've seen here, but specifically, HSBC Asset Management runs a emerging market corporate green bond fund. So that's something called Regio, the Real Economy Green Investment Opportunities Fund. It's 580 million in size, and it's a buyer of high quality EM corporate green bonds. So we think with a green bond, you're funding, green projects, you can get a good financial return, and we're also helping to build the capital markets. So in that respect, the Commissioner McGuinness mentioned the EIB 2000 bond issued, the green bond issued in 2007. Obviously, we've seen a lot of innovation in the green bond market, green, social, sustainability linked. But we're very much focused with this fund on green bonds in the emerging markets or the developing world to help put money to work on green projects in those regions. Secondly, I would say natural capital is now a rapid growth area, and we are also creating a fund called CAM, Climate Action Management, which is going to invest in sustainable forestry and restorative agriculture. Over the last year or two, it's been a realization that if you preserve natural capital, you're preserving biodiversity and also slowing climate change. We've also had some metrics developed like mean species abundance that allow you to measure biodiversity at sites and compare sites. And also the net zero commitments mean there are sort of natural buyers of nature-based solutions. If you don't get your emissions down to zero, you're a natural buyer of natural capital solutions. So I think those are two trends: further growth and breadth in the green bond market, and then natural capital is the second one that we're investing in. Thank you.
Thank you, Michael. Yes, as you say, more investment is needed in emerging markets where certainly public financing and funding is quite limited. And the growing focus on natural capital as well is an interesting and needed, obviously, investment trend to be able to focus on things other than climate change, which of course is very important, but as you mentioned, biodiversity and forests, et cetera, are also extremely important. So Jen, what are you seeing as a top investment trend in sustainable finance?
Thanks, Denise, and thank you for Luxembourg for Finance for having us. I think the one trend that I want to pull out that I think is quite close to my heart is talent and development. And specifically, I want to talk about the rise of the dedicated sustainability professional within finance and what implications those are in terms of how we transform the broader industry. I think let's start at the beginning. I think it's safe to say there's a huge demand right now for ESG professionals, not just in finance, but in companies and consultancies and NGOs and so on. And I think there's a clear mismatch of existing supply. As someone who is working in the field for 10 years, it is a little bit of a, be careful what you wish for moment. But the nature of the role is changing. In the past, being a sustainability professional was about data and disclosure. I think now it's safe to say that it has very much moved to the heart of business strategy and contributing to broader systems change. And an ESG professional is expected to be multidisciplinary, someone who can understand business, finance, regulation, product development, communication, and on top of that, have specialist skill sets in climate or biodiversity analysis or social impact or so on. And beyond these hard skills, I would say that the soft skills are very sort of become to the forefront, because I think real ESG integration in finance is as much about persuading and influencing and guiding and educating. It's about winning hearts and minds as much as it is about policy and procedures and data and metrics. So what you need is people who are adaptable, who are creative, who can function in conditions of uncertainty, who can hold contradictory ideas in their minds, but still be able to connect dots. And this, to me, is where diversity is so important, genuine cognitive diversity. We need people who think differently in this field because we are trying to create this change from what we had done previously in the past. And I think the final piece to me that's the most important part about the sustainability professional, I think in some ways, the sustainability professional mirrors the rise of the risk professional. It's a specialist discipline that has grown enormously in importance. You talk about embedding a risk culture as much as you talk about embedding a sustainability culture these days. But in one key respect, it is different, which is that for all the data and metrics around ESG, sustainability is and should be about passion. You have to be philosophically invested in the outcomes you're trying to create. I think Michael talked about that very well. And you really have to believe, I think, that finance is a force for change. And so finding someone who kind of ticks all these boxes, I think suffice to say that is a challenge for us. But I think the real opportunity here is making sure that all these skills I just talked about are taught in the next generation of finance professionals, because that is what I think is going to change our industry and make it a better place to work.
Great, thank you so much, Jen. Thank you for talking about a topic that is so near and dear to my heart, and actually not often talked about when we talk about sustainable finance, investment, and the challenges. I think that clearly education it enables investment firms to implement a coherent investment strategy around sustainable finance. And of course, you need the talent to implement that strategy. And demand, of course, for sustainable finance talent has increased greatly. Is an understatement in the last year or so. So I think we'll only see more demand. And as you rightly said, I think it's challenging to actually, it takes a number of different elements to create an ideal sustainable finance talent. And it's not just about school, and it's not just about the passion, it's a combination of all of that. So I'd like to ask our panelists now for their views on a number of, a few additional trends that we see in the sustainable finance investments sphere. And I'll ask one of you to start, and please, the other two, please feel free to chip in after the first person speaks. So global aspects and challenges of sustainable finance investing, excluding regulation, because the panel after us will talk at length about that. I'd like to start with you, Jen. You're based in Singapore. Could you give us some insights on sustainable finance trends in Asia? Thank you.
Yeah, so I think, if we step back a little bit, ESG, was kind of born as a concept in Europe, and I think within Europe it still remains the most well developed. But I think there's no doubt that Asian regulators and Asian companies are catching up very fast. And when we look at our global client base, I think there's no doubt that the interest in sustainability is all the way around the world. It's no longer a regionally specific phenomenon. And I think the potential for Asia to contribute to a lot of these ESG solutions that we have here really can't be understated, right? 60% of the world live in Asia. Just over half of the world's carbon emissions is generated from Asia. Asia has a huge role to play in the decarbonization challenge ahead of us, a huge role to play in preserving biodiversity and the natural resources that we need. So I think to me, the biggest investment trend in Asia, full stop, is the rise of ESG as a force within the Asian financial markets and the Asian business sphere. It's something that all the corporates that we are meeting are talking about now. In fact, a lot of the companies that we engage with proactively raise this as a topic to us because they recognize that this is something that investors care about and they want to understand what matters to us and therefore reflect it in their business practices. And so that for me is the real opportunity of including Asia in this discussion.
Thank you, Jen. Julie, Michael? Any comments?
And I think just in this context, what is really important is really to try to focus on avoiding market fragmentation and making sure that while we are fighting global challenges all together, so I think that cross-border cooperation is absolutely essential together with coherence as well. So really trying to make sure that we can adopt exactly, well, not exactly, but the same language, at least being able to understand each other. And I think that the work that are already undertaken by the EU in this context with the international platform on sustainable finance, where a subgroup is led by the EU and China to establish a common ground taxonomy is very important. Hopefully we should this report released very soon.
And Julie, I guess you've had the opportunity as well to travel, perhaps sometimes just virtually, to the US and other parts of the world. And so are you cautiously optimistic when you hear what's being discussed in terms of actual?
I would love to. I would love to. I think that the approach is quite different. In the EU, as we were saying so far, it's more and more regulatory driven. But all started with the market and market players, which under the ICMA initiative and the Green Bond Principles at the end, which comprises more than 200 investment banks, mainly from the beginning. In China, it was clearly more a top-down approach and regulatory-led with PBOC guidelines and a Green Bond Catalog issued in December 2015. And at that time, we were only signing the Paris Climate Agreement. While what we're seeing now in the US is much more focused on, climate disclosure. I think we will see some guidance from the SEC by the end of the year. And I hope that it will not be so much focused on punishment and sanctions, but also on encouraging people to onboard, because this is really essential, and bringing trust to the market, especially in the US, where so far there's no standard, especially in terms of green bonds. So think potentially the US leading the way with a sovereign US green bond would bring a lot, I think, in terms of sustainable fixed income market, especially for US investors.
Thank you, Julie. Michael?
Yeah, sure. I would sort of say three things, if I may. And it's very interesting, the comments about Asia. But firstly, I mean, in terms of next steps, I'm seeing a lot of interest in the alternatives space. So infrastructure, direct lending, private equity, to bring in ESG integration, but also actually in the private equity space, there's a lot of focus on impact. So actually there's sort of two tribes. There's the sort of green bond people who are doing impact through their labeled securities. And then you have the private equity space, often in the US, who are doing impact. And it's kind of the same thing, but slightly different conversations. But the impact story, i.e. beyond ESG integration is a sort of a given in many respects. It's about impact for some funds. So yeah, moving in the toolkit into the alt space and then focus on impact. In terms of Asia, I mean, I tend to think of Asia, particularly if you're an impact investor, you'll want to put your money to work and get a good return in terms of not just financial, but also having a positive environmental impact. Your money is going to flow from Europe and the US to Asia. Because, for example, if you're funding a wind farm, if you build one in China or India, you're probably going to replace coal. If you build one in Denmark, you probably replace gas or other renewables. So net, money should flow into Asia to purchase impact, because you're getting a good return in terms of CO2 being driven down. So I would say fairly dynamic. You know, we're getting expansion into alts, but in terms of the global scale, particularly because CO2 is a uniformly dispersed pollutant, and you want to move money into Asia to bring effective emission reduction. And hence we're doing the Regio Fund, which is it's an emerging markets, but it has a big Asia focus to it.
Thank you, Michael. So private equity actually is an early starter in many ways in impact investing. And then, as you rightly say, the investment opportunities in Asia. So thank you for that. So now we speak of the rise of social. I think we've heard that today a couple of times in sustainable finance, given COVID-19 in particular, and Build Back Better. Julie, would you like to start us off with this question in terms of the trend and what you see happening in the social space, if you will?
Well, as you rightly say, during the pandemic in 2020, we saw really an exponential growth in social bond issuances. And this instrument emerging as the fastest growing segment in the sustainable bond market. I think that there was clearly, well, due to the pandemic, the S of ESG came to the fore. And there was a huge shift from green to social with lots of diversified issuers. I think this reflects clearly a new awareness and a stronger focus on impact, and both from the investor side and from the issuer side. And let me maybe illustrate this with figures and what we saw on our platform from January to September 2020. So clearly linked to the pandemic, almost 60 billion euro of social and sustainability bonds were issued for the first 9 months of 2020. While 25 billion euro of green bonds were issued, whereas green bonds were always the leading sustainable finance instruments. And this trend is really continuing in 2021. And according also to a CBI survey in the sustainable debt market, for the first half of 2021, issuances with social themes have quadrupled compared to last year, same period. And so on the green exchange, the number of social bonds having been issued for the first half of 2021 increased by 58%, while in terms of volumes, it increased by 300%. So it's a huge increase. It's clearly the fastest growing segment in sustainable bond market.
Thank you. Mackel, Jen?
Well, I'd just jump in and repeat, and I say, in the green bond market, the social and sustainability bond issuance is very interesting. I mean, sustainability bond issuance, where you can both fund green and social, is very attractive to sub-sovereign issuers, so the likes of regions, provinces. And that, if you're, province of Ontario, for example, or state of Victoria, you're able to issue a bond, sustainability, that allows you to fund both, metro systems, social housing, renewable energy. So it's quite a nice toolkit if you're in that space, that you're not necessarily a sovereign, but you're a sub-sovereign and you're serving your community to provide both social and environmental offering is quite a powerful tool. And I'd expect it to keep rising as a sort of source of finance for the sub-sovereigns, indeed.
Thank you, Mackel. Jen?
So I agree. I've sort of mixed views about this. I agree with Denise, with Julie. I think the S part of ESG has been given a huge prominence by the pandemic. And I think the pandemic has both revealed and exacerbated existing societal inequalities. And now that the ball is on us when we think about building back better or building back greener or whatever, what can we do to address these structural inequalities that have been revealed? Where I have a different view is that I don't want to just think about S or even G or even E as being a different asset class, as being just limited to kind of financing instruments. I think the potential of ESG in sustainability and finance is to occupy the mainstream of all of finance. So when I think about how do we integrate S, I think about business practices at the world's companies. How can we get those companies to focus on S issues better, whether it's issues of diversity and inclusion, or issues around employee well-being, or issues around better contractual pay rights, zero working hours, so on and so forth. What can we do to kind of move the needle around the vulnerable yet essential workers that we know we all need, right? And that I think is where, if I contrast what's happened on the E side with COP26, you've had such a powerful galvanizing impact through COP26 on climate ambitions globally. Like every day you see companies announcing net zero ambitions, targets, new investments and new solutions, the funds that Mackel spoke about. I think that's terrific and amazing stuff. I think we need to see that kind of momentum around the S issues as well. And I worry that S is by definition less well defined than E. We can all kind of talk on issues around it, but saying what it actually is a little bit more challenging. And I think so to me, the next step in really moving the S forward is how can we measure genuine progress around S? What do we mean by good S? And then how do we incentivize companies and investors to promote those kind of concepts in the way that we've done very successfully with E?
Thank you, Jen. Yes, and you hit upon an excellent, in addition to saying very accurately, I think that it's very difficult to define social issues. And I think the EU taxonomy, the social taxonomy, will be a good challenge, put it that way. But I think the other point you made as well at the end was measurement. And I think that's clearly a challenge that all investors and asset managers and insurance and banks companies are having to deal with, and will have to deal with, of course, in the near future. How do you measure all of this? Because of course the reporting, if you're an asset manager, certainly in Europe, you have got the clock is ticking for you to have your first SFDR report in terms of how you've done in terms of what you've set out as goals. So lots of good work and challenges ahead.
Maybe,
sure.
Denise, if I may, so underline that, of course, this rise in social issuances have been also strongly supported by government and sub-sovereign, as Mackel just underlined, but also by the EU itself, with the EU SURE program to protect workers and jobs post-pandemic, where we might be able to measure in terms of creation of potential new jobs in the future. And with 17 billion euro for the first tranche, and up to 90 billion at the end, I think they are clearly leading the way and strongly supported, of course, the rise of social bond issuances.
Good, as you say, rightly said, yes, thank you. So we kind of touched upon it a little bit, but the rise of ESG in investment is bringing about changes in investor behavior, or actually is it the other way around? So in any case, Mackel, perhaps you could take us through and start with the topic of changing investor behavior when it comes to sustainable finance investing. Thank you.
Changing investor behavior. Well, I mean, I think in many respects, we are witnessing that currently. I mean, one of the things that we have to do is trying to provide products that can address a lot of these issues. What I'd say about changing behavior is, we've talked a lot about the fixed income market. The first 10 years of my working career in the fixed income market, we had no innovation. And then the last 10 years, we've had innovation every single year. So I'm very impressed with the way that's gone on. I would say, though, that innovation can't just happen in the financial markets. It has to go hand in hand with government. And it does slightly upset me when people meet me and say, oh, you work in finance, please give us the solutions. And it has to be done hand in hand, with clear regulation. So, carbon pricing, regulation, and I guess large-scale consumer boycotts are what really move markets. There's lots of discussion in the papers always about ESG issues, but we're always looking to see what's going to make that concrete and what is going to sort of actualize that to have an impact on companies. So yes, I would say that people have integrated the ESG model, which is basically to look at companies and say, what are the emerging ESG risks that they're going to face? When are these going to impact the firms? How large will the credit impact be? But not only that, is the firm able to anticipate these ESG risks? Are they able to exploit or avoid them? So that sort of prism is looking at companies and having to take into account not just the current financials, but the emerging ESG risks is a very real thing, which has driven a lot of work over the last 4 or 5 years. On top of that, we're trying to look at products, and then I guess the big issue now is the net zero commitment, which is about transition risk, but we also have other risks on top of that, including the risk of real climate impact or negative impact on companies. So there's a whole lot of things that are being grappled with currently. And we hope that COP26 will take us further as well.
Thank you, Mackel. Jen or Julie?
Yeah, perhaps I can just sort of chime in on investor behavior. So that my view is that investor behavior has changed already, right? And it's changed for, I would say 2 reasons. I think the first is that it's now quite clear that it is a core part of your fiduciary duty as an investor to integrate ESG issues, even if you define it as narrowly as as financial outcomes. The structural weight that society has placed on ESG factors means that it is increasingly an important part of assessing the future value of a company. And so if you want to make good long-term investments, then to me, you have to integrate sustainability considerations into that. In fact, I'd go one step further. I'd say that sustainability considerations are now moving to the forefront of the competitive advantage of companies versus their peers in the same industry. So, in a world where we have better carbon pricing, carbon markets, carbon border taxes, for example, companies that operate at better carbon efficiencies for the same product are going to perform better versus their peers who will have higher cost bases. So I think that's the first reason. I think it's a very pragmatic reason. I think all investors kind of need to kind of get on board with that, and I think largely have. I think the second, which I think is a more fundamental shift that we're observing, is how the pandemic has put the spotlight on corporate purpose. The idea that profitability is the outcome of purpose, it's not the purpose itself. And I think that's a notion that I very much subscribe to. I think a lot of companies that we invest in subscribe to that same idea as well. You're here to try and fulfill some some societal need. That's your purpose as a business, and the profit that you generate comes about from fulfilling that need in a sustainable way. And so I think finance is no different, because I think in a way the application of sustainability towards positive societal and environmental outcomes has moved to being much closer to being the purpose of asset management and the investment industry.
Mackel, are you in your firms, are you still having discussions, or within your firm, are there still discussions with investors about having to give up financial return for sustainable ESG non-financial return, put it that way, or is that a topic that has gone away?
No. Still very much there. Still things that people talk about. Look, I think people conflate two things with ESG investing, right? One is the integration of ESG factors into a traditional investment process, and this for me is a structural investment shift. It's a change and evolution in our investment process. And then there is investment into companies that address positive sustainable needs. Those two things are not the same thing. Right? If you want to invest in a sustainable theme, whether it's renewable energy or alternative meats or electric vehicles, that's completely okay. You're very welcome to do that. But those things are subject to the same demands of same laws of demand and supply, valuation, overvaluation, undervaluation as any other theme you want to invest in. So to me, when I have conversations with clients, it's about sort of making clear, look, what is it you want ESG to do? Moving beyond that, ESG is, very important, blah, blah, blah. And then, what actually is it you want it to do? And then based on what you want it to do, you can have a discussion about what the best way is to do that.
Thanks, Jen. Michael, anything you wanted to add there?
No, I think there's very wise words, actually. I would say that probably that's right, that the way I've been pitching ESG is a sort of risk mitigation, but we are actually at the same time moving beyond that to a sort of, well, it's not just avoiding the firms that are not ready for the future world or today's world, but it's also now choosing to put money to work in the climate change solution providers, of which there are more and more sectors. Now, one has to be totally aware that it's not just, oh, this is a growing sector. The growing sectors can be very competitive. So, if only half of the work is finding out the growth sectors, it's then trying to work out which companies are going to do well in those climate change solution providing sectors. But I think our colleague speaking in Singapore is right. It's not just the risk mitigation. It's now putting money to work on the upside. And it's a different approach work, but it's still, growing, I would say, that latter area.
Thank you, Michael. Julie, did you want to add anything? Investor behavior, any changes? Are you seeing that?
Well, I think that, as said, especially in the fixed income area, at least, they are not looking only at green side projects. This is not enough anymore. This is really what they want to understand is really the sustainability approach and strategy of the issuer. So it's a combination of the product level and an assessment at the entity level, which now is clearly the trend and underlying also this transition movement we have to support.
Thank you. Well, I think we've actually come to the end of this great session. I really appreciate all of your input, and obviously we could continue. We've aimed to focus on sustainable finance investment trends globally and where we are with those and where they need to go. I think I've heard that as well. Some of those trends are overlooked, so the topic on talent, I think, is definitely an important one. So thank you for that, Jen. And I would like to thank our speakers, Julie, Michael and Jen, for joining us, for their knowledge and expertise, and for giving us all a lot to think about. So over to you now, Judith. Thank you.
Thank you so much, Denise, Voss, there with our fantastic panelists from around the globe. And I just want to express my appreciation for the panel truly teasing out that double impact, if you will, that this sustainability, this sustainable finance drive actually has. Not just investing something that's positive for the environment or for biodiversity, but actually that transformation that is underway in the whole financial industry. So thank you very much. And we continue to build on the themes we just heard about with our next panel, because we'll expand the conversation from, if you will, capital to coordination and cooperation, something that Julie already spoke about that is so important to get everyone on the same page, as it will. The taxonomy has made a huge splash around the world, but what may be green in Brussels or Paris is not maybe the same shade of green in Shanghai or elsewhere in the world. And as investors are being pushed and pulled by different taxonomies being developed by public authorities, are we heading for global fragmentation or convergence? And let me just remind you of what Commissioner McGuinness said earlier in her keynote. She said that the EU Commission strongly promotes convergence and ambition when it comes to sustainable finance at an international stage. And she also said that the International Sustainable Finance Platform is about to publish a report on a common ground taxonomy, setting out a common common features in existing taxonomies. So food for thought, and to discuss this more in detail, I have the pleasure to welcome our next panel, and indeed the panel moderator who said during our preparation, convergence and fragmentation is something I live every day within my work. He's Stephen Nolan. He actually funded Sustainable Finance Ireland back in 2015 and led it until 2019, when he was asked to become the managing director of the UN-convened initiative, Financial Centers for Sustainability, which overall includes 36 international financial centers. He also leads the Sustainable Insurance Forum, which comprises of 32 insurance supervisors, and in addition to the above, his team looks after the recently formed APAC Sustainable Finance Network. So, warm welcome, Stephen Nolan, and over to you and your panel.
Thank you, Judith, and thank you for having me and my panel members with you today for what is a very exciting event. I think it will be clear to say Luxembourg is a leader in sustainable finance, has been a leader for quite a while, and sets the bar for other jurisdictions, not just in Europe, but around the world. So it's great to be part of this important event just a few days out from COP. You mentioned I oversee several UN-convened platforms, the Financial Centers for Sustainability, the Sustainable Insurance Forum, and now the Sustainable Finance Development Network in Asia Pacific. And if I may, just before we get into the panel, some of the challenges that we see within that, Judith, from our members are around skills or lack of skills in sustainable finance to really scale up the sustainable finance agenda. Data, incomparable, inconsistent. Again, both skills and data being key building blocks to firms to develop new products or services in the area of sustainable finance. And of course, policy and regulatory convergence is a key challenge we're going to get to in a moment. And the fifth challenge, Judith, that we're seeing, that I'm grossly oversimplifying, is that there's perhaps too many initiatives for the private sector in this agenda at this point in time. So let's get into our panel, because as I noted, within those top 5 challenges, policy and regulatory convergence is one of the big ones, Judith. And we've got a great panel to discuss this topic today, as you introduced it so well a few minutes ago. And the panel will examine the way in which we are moving on this agenda, either towards convergence or fragmentation, and the current effectiveness and state of sustainable finance regulation in various regions. And as you noted, the Commissioner McGuinness, is very keen to see conversions on this topic at a global level and support not just Europe's ambition, but ambitions from other jurisdictions. So with us today, we have a blue chip panel. We've got Rick Lavelle, who's the global head of ESG at State Street. We've got Petr Wagner, who's the acting head of Unit for International Affairs, European Commission's DG FISMA. And we've got Tracy Wong Harris, who's the Vice President and Deputy Secretary General of the Hong Kong Green Finance Association and Head of Sustainable Finance, Greater China and North Asia Standard Chartered Bank. So we've got an absolutely fantastic panel. So let's kick off then, if we may. And Petr, if I may turn to you first, we heard Judith earlier on mention the remarks made by Commissioner McGuinness today, who opened today's event. And she was highlighting recent European activities in this area, not least the launch in July of the renewed sustainable finance strategy. So as I noted earlier on, Luxembourg being a leader at a national level within Europe on the sustainable finance agenda. But I think it'd be fair to say that Europe has been a leader in sustainable finance at a global level these last few years. If, underpinning the financial sector's climate action agenda, Petr, what next for European action on the sustainable finance agenda, please?
So thank you, Stephen. Hello, everybody. First of all, thank you for having me at this very distinguished panel. So let me do a little pitch on the EU before we delve into the global aspects of convergence or potentially, hopefully not, fragmentation. I mean, obviously, the sustainable finance has been of the EU's key objectives for quite some time. And quite frankly, we are very happy to see that that has become now really a global issue with more and more partners actually joining these efforts. We started to work on this already in 2018, and we've not deviated from our main 3 building blocks, which we do think may be relevant for the world, and that is the taxonomy. So in the current situation, it's the EU taxonomy. It should be the common grammar for all sustainable finance activities. Then disclosures, the rules on disclosures for investors, banks, and companies to ensure proper transparency for all stakeholders, and what we call the tools, the standards and labels. We had indeed published in July a communication which is called a renewed strategy to financing the transition to sustainable economy, so the sustainable finance strategy, to kind of outline a comprehensive approach to ensure that climate and environmental risks are adequately identified and managed in the financial system, in particular by banks. One of the key areas for us there is improving resilience of the financial sectors. For instance, we intend to review the toolbox for regulators and supervisors to ensure that environmental, social, and corporate governance risks are adequately managed through the prudential framework. We obviously build it on 4 pillars: this transition, inclusiveness, resilience, but also global ambition. So, as this panel is on globalization, global issues, let me circle back into that immediately. And here I would say that it's absolutely clear that we need to do this all together, but we must acknowledge that the starting points and priorities of each jurisdictions or region sometimes are different. So what we're trying to achieve as the EU here is to maintain a level, the term we're using is to maintain a level of ambition that is proportionate to the challenges at stake. And that is kind of, for us, should be read as that, the ambition should be high, because the stakes are really high. But we acknowledge, as you said at the beginning, that this is not going to be a one size fits all from the get-go, because we're talking about transition. So if you look at it on more details, for example, on sustainability reporting by companies, our proposal for what's called the Corporate Sustainability Reporting Directive aims to support a long-term strategy shift by requiring large companies and listed companies to disclose sustainability targets and progress towards achieving them. Now it's mandatory, we want, and also our intention is to look at double materiality. So we'll cover all sustainability topics under a double materiality perspective, encompassing risk affecting the value of companies and impacts of companies' activities. We do believe that this is the information financial markets want and need, but markets are obviously global. And so we are mindful that we will need global alignment of reporting standards, and we would like to build on and contribute to these global standardization initiatives. So in this slide, we see the International Financing Reporting Standards, the IFRS Foundations Initiative, as a baseline on which we would like to build according to our own political and legal priorities. Now, the cooperation between global and regional standard setters will be key to assure coherence and interoperability. And I think the word interoperability is something we'll be hearing a lot going forward. For us, the European Financial Reporting Advisory Group, the EFRAG, is already in touch with IFRS and starts to look at this issue. We have also integrated the key concept of the Task Force on Climate-Related Disclosures, the TCFD. Now, another contribution, which is not purely EU's, but we have largely kind of we're at the beginning of it, is indeed the International Platform on Sustainable Finance. This is an informal platform of a number of jurisdictions. It's not an EU thing, but we are, I want to say, a prominent member. And currently, we providing the secretariat for this initiative. And that platform covers actually by now 17 members, which account for more than 50% of world population, roughly 55% GDP, and most importantly, 55% of global green gas emissions. And this is where we're trying to go really in depth of issues like taxonomies and going forward, the double materiality, just to strive for information exchange, learning, coherence, convergence as much as we can. On a voluntary basis, obviously. Now, the IPSF, I think, has registered some successes. So first of all, it's been acknowledged as a knowledge partner for the G20, and has been, then fairly important in our discussions for agreeing the G20 sustainable roadmap and the synthesis report, and what we're gonna do with the IPSF, at the occasion of the COP26, we're gonna publish a few reports. One of them you have already mentioned, and I guess we're gonna come to that a little later at the panel, which is the Common Ground Taxonomy, which will be, once we do it, a sort of a first step towards comparing certain features of various jurisdiction taxonomies. And as such, I think that is an important step for global, coherence and convergence. Now, one last thing I would mention, of course, the other thing is what we need to look at particular countries' possibilities. I'm looking at here now at emerging economies, where they indeed have different possibilities, from capacity building all the way to having a different transition targets. And I think the European Commission is aware of that. And obviously we had to start in the EU, but we're not losing from sight the global, the international perspective with the view to either coherence or interoperability. But I would stop here.
Thank you very much for that, Petr. That was kind of I'm exhausted listening to you. There's so much going on at the EU level and what the EU is involved in. And obviously, Martin Spock, John Berrigan and colleagues over the last few years, and yourself have been leading this. And obviously we heard Commissioner McGuinness this morning, as she said, she wants to maintain that level of ambition. And in order, I think that one of the key things she says that Europe cannot do this alone. And I think you've just outlined very clearly there the different platforms and different ways that Europe is involved in trying to ensure that others also play their part. Tracy, if I can just move on to you, because you're very active in Hong Kong and the wider Chinese region in your role with Standard Chartered, but also with the Hong Kong Green Finance Association. And again, you've been a leader in this space for over a decade. We just had Petr talk about global ambition and maintain that level of ambition. But a key word I heard there, as you said, Petr, we'll hear a lot more, interoperability. And I can remember my background is technology. I can remember interoperability around mobile technology, different regions, and how important that was to allow us to have a seamless network globally. So if we look at sustainable finance in that same vein, Tracy, based in Hong Kong now, what are you seeing in terms of collaboration between the EU and China, specifically on a possible EU-China taxonomy, please?
Thank you for your kind introduction, Stephen. Also to congratulate Luxembourg Finance for the 4th Finance Forum. Delighted to be here today. And I have a little story to share. I think Mr. Wagner also alluded to on this China-EU taxonomy task force. So my little short story was the agreement of setting up the EU-China taxonomy task force to harmonize the two taxonomy between EU and China was actually happened and agreed back in 2019 in Hong Kong. So it was at a SFC Green Finance regulatory meeting where the representative from the EU Commission, the US TCFD Secretariat, and both China and Hong Kong regulators were present. So Mr. Ma Jun, which need no introduction, suggested for both EU-China to set up this harmonization task force to look at the two standards. And the task force was set up last year, and with the expect that the first draft of the Common Ground Taxonomy to be published very soon, end of this year, I hope. And we believe that this EU-China taxonomy harmonizations will form the biggest piece of a common ground standard to fast-track sustainable finance market. And in Hong Kong, we welcome these developments, and we look to adopt this common ground taxonomy when it's available. So very much looking forward to that. And taking the opportunity to share a few key developments in this side of the world as well. So the Hong Kong government has long been set up this green bond program of 200 billion worth of program. And for year to date, the Hong Kong government has already issued up to $3.5 billion equivalent of green bond. With this year, we issue a 30 years long tranche, which makes the longest green bond issuance by Asian governments today. And also, the Hong Kong has set up this cross-agency steering group, which composed of 2 government bodies, the Environmental Bureau, FSTB, and 5 regulators, which is the Monetary Authority, Stock Exchange, SFC, the Insurance Authorities, and the MPFA, to really look at positioning and drive Hong Kong to be the regional green sustainable hub. And recently, also, they have announced the next step. Let me highlight a few. So they are announced that to mandatory climate-related disclosure aligned with TCFD framework by 2025 across relevant sectors. Secondly, to set up a carbon market work stream, which is co-chaired by SFC and Hong Kong Stock Exchange, to facilitate the development of a regional carbon center in Hong Kong, to play a strategic role as a China gateway to mobilize capital for achieve the carbon neutrality goal. Also, a steering group, the steering group also launched the Center for Green and Sustainable Finance to help financial industry to manage the risk and capture the opportunity presented by climate change. And the centers across is across a platform to coordinate between financial regulators, government agency, industry stakeholders, academia in capacity building. So going back to you, Stevens, about collaboration, the importance of collaborations across both public-private sectors in dealing with climate change. I stop here.
And Tracy, I was on another session recently with Judith, and she spoke with 3 C's: collaboration, coordination, and capital. And I really like the way she summed that up. So there's a lot going on in Hong Kong, and Hong Kong, like Luxembourg, has been leading this agenda for quite a while now. If I could just roll it back to all those different things you're doing, but specifically around the EU-China taxonomy. And you said, sure, it'd be great if we see the harmonization. And Dr. Mao Jun, who I think is fair to say is a legend in the green and sustainable finance agenda. But why is it, in your view, why is this collaboration so important between the EU and China? Just go a little bit deeper, then we may see a first draft. You're in the markets, you're with Standard Chartered. Why is it so important, please?
I think like standards been a long debate across the market, and we have like from channeling capital perspective, from from financing perspective, we would like to be able to compare transactions across. So if all the country, 197 countries, have they pop up their own taxonomy, we will need a really long time to go through trade to compare look at our portfolio. What does it mean? So having a standard across the market will really facilitate this effort. And given that EU and China are the only, the 2 leading ones came out with the standards, and we believe that the harmonization between the 2 pieces will form the biggest common ground for the market to facilitate this effort.
Great. Thank you very much for that, Tracy. And again, Rick, if I could come to you, you've been sitting there very patiently with that beautiful backdrop behind you. And again, I'm going to go back to Petr's word, interoperability. Tracy's using the word harmonization, but I really like that interoperability word. It's a real technical word, right? As the CIO of State Street Global Advisors, you more than most recognize the importance of capital being able to flow freely across borders and within regions. And that's what I thought the point Tracy was getting at. And indeed, we need to see this happen in this space if we can meet our net zero ambitions. So if I can, Rick, how similar do standards need to be between the major blocks of capital in order to maintain function and effectiveness and ensure that capital is low cost, please?
Right, thanks you. Well, first off, I think it's widely appreciated that common standards are beneficial in many areas. You look at how mobile phones developed under GSM, for example. Europe set the standard. It quickly transformed, and you had the sort of classic interoperability that was possible as a result of that. So I think it's very important. However, there are whole swathes of the disclosure world, the regulatory world, that are not converged at all. And yet we do live in a world where globalization of both investments and sort of industries has been more and more commonplace over the last 20 or 30 years. So despite the fact, for example, tax rates, and I think we recently got this incredible breakthrough with the OECD on tax, but for many years they were unharmonized. The way pension fund accounting works was unharmonized. And so if you're an analyst looking at comparing companies across border, you had to manage that and it had a cost. It had a cost in terms of time of effort to try and work out how you could make it comparable. So there is a benefit in comparability, but it's not true to say that people can't really function effectively without it. So it's important that we have that ambition to get there, and particularly when it comes to things like minimum standards. If you're trying to define how you will estimate scope 1, scope 2, scope 3 emissions, we can tolerate some differences in national approaches. At the moment, it's voluntary anyway. So you could accommodate some. And I guess you have to ask yourself the question, how different do they need to be in order that we say that, well, that's a really big problem. And at the moment, we don't have any data that's mandated at all. So, we're managing the problem one way or another. So I think the overall ambition has some real strong benefits, but we shouldn't get carried away with the fact that we need to have convergence either quickly and that we can't actually do a lot when we've got a lack of convergence. What would cause lack of convergence is national interests differing and population preferences and investor preferences different. It's unlikely to rest on pure technical issues. And again, if you look even within Europe in the power generation area between the debate on nuclear and gas, you can see that these aren't necessarily technical arguments. They're arguments about national preferences and political freedom. So I think the ideal is that you aim for convergence, you allow some degree of competition, because that's the other thing, as you converge, you don't want to be stuck in aspic. You want the thing to continue to improve and to absorb ideas and challenges from different parts of the world on that converged standard in order that you can get better and better. And maybe what epitomizes this is the approach of entities like IFRS. You mentioned them earlier. IFRS is an interesting place to start because it's not mandatory and yet it's very widely adopted. And it's seemingly taken some of the political dynamic out of the process of putting together a common set of standards. I think that could be, in a sense, that is to some extent the Achilles heel of trying to set global standards in this area of sustainability. Because national interest, particularly between developed economies and emerging economies, can be so starkly different. And we haven't even started talking about the US yet, which from an economic and financial perspective comes with a very different historical philosophy to many other parts of the world. And you can say, well, that's a problem, but you just have to recognize that's a reality that we need to encompass the best thinking in the US as well as elsewhere. If we're going to get to a nirvana state, which I think would be a large degree of convergence, very strong minimum standards, ambitions that are somewhat competitive, not a race to the bottom, but competitive in sense of saying what really makes sense. How can we sort out what really matters from what doesn't matter, and have that very robust dialogue between different actors in order to drive standards up to the appropriate level. I think that would be what I'd aspire to see happening. I think the China-US dynamic is particularly interesting because China, being part of the emerging economies, faces, particularly in energy, a more complex challenge than perhaps we would see in Europe. And maybe that's a way of putting it a little bit diplomatically. But I mean, in common with much of the emerging world, they need to find a way of continuing to grow and to alleviate poverty. And that creates a little bit of challenge. If you just think about how you're going to think about banks in emerging markets when you look at their TCFD reporting and their ambition, you've got to think of them a little bit different to a Danish bank or a bank from a developed economy, which is not nearly as energy intensive. And in a sense, that does, maybe Peter, you mentioned it earlier, this kind of idea of flexibility and understanding the point that different people start from is absolutely vital. But we need to keep challenging how much convergence do we need and look at the cost benefit of going that extra step.
Thank you for that, Rick. And Rick, if I may just unpack a little bit of your insight around the US. I moderated a panel recently. It was 10 months into the Biden administration and the action on sustainable finance. And it's quite significant. But if you could maybe unpack just your thoughts around what you just said there, the US's role in this global convergence. Where do you see the US perhaps in 6-9 months on this agenda? Are you seeing a lot of momentum behind it within DC and the SEC and others, please, Rick?
Very strong momentum, and I think well, I mean, there's E, S, and G. I think they're all important, but I think particularly environment and human capital issues are being driven into the agencies very, very strongly. And I don't think it will be the same as Europe in having a taxonomy. I think the architectural differences are pretty important. If you look at the SEC, for example, it has no leverage over private companies, and yet we know that's one of the big fault lines between listed and unlisted companies when it comes to things like disclosure. So not everything will get fixed, but if you think about the way that the agencies are tackling the problem, really going at it hard, but with an underlying philosophy which could be different to other parts of the world, which is you've got to look at the financial materiality and you've got to look at this through the economic lens. And I think the double materiality argument is kind of say just less likely to hold sway, at least in the short term in the US. And it's much more likely to be focusing on first order impacts and also what's measurable. I think the other thing that maybe US has learned a little bit in relation to Europe and the approach it's taken is you've got to look at investor regulation or fund regulation and issuer regulation simultaneously. You can't start with investors and then leave the issuers to be dealt with later. And you can't also substitute good policy making in terms of making actual laws from a sort of process of encouraging investors to lean in the right direction. So I think those are both things that will mean the pattern in the US a little bit different to Europe and elsewhere.
Okay, I'm conscious of time as well. We only have a few minutes left. Tracy, if I could just turn to you just for a moment before I get back to Petr. What are you seeing, given your role within China, Hong Kong, within Standard Chartered? How are you seeing clients react to this convergence or fragmentation agenda, please, Tracy?
Yeah, sure. I really like Rick's comments about the differences between a bank that has most of the footprints in emerging market or compared to a Danish bank. So as Standard Chartered, so we are committed to operational net zero by 2030 and financing net zero by 2050, of which in a matter of days, we will be announcing our financing net zero pathway and disclosing our own financial footprint. So very exciting time. And that will be including our deep dive into the sectorial, like the high carbon intense industry sectorial deep dive on the transition pathway for our clients. And given our emerging market footprint, like I mentioned, and the net zero ambitions, we'll be taking an even more active role in facilitating our clients transition their business, including the sectoral deep dive that I mentioned, transition advisory, and financing, and also really engaging a bottom-up approach with our clients. And if I may, Stevens, talking about the market as well. So from the market's perspective, we as everyone have seen, the sustainable finance debt market has really exceeded last year's total volume already by mid-year. And with a particular product on sustainability-linked loan, which is double of last year. And this is one of the instruments where to be able to help to articulate the transition basically pathway, where the borrower, the loan margin is tied to the borrower's performance and ambitions targets. We have seen that this is how we can try and use to move the needle in moving to the net zero pathway. And Great. It's not just loan, it can be applied to across different products as well.
Okay, and Rick, you know, as CIO, State Street Global Advisors, you know, you guys, and I see this are developing, you know, new products, new services similar to what Tracy's looking at. Again, from your perspective of your clients, the hunger for those products and services, their transition journey, Rick, where are we at, please?
Very strong, and I should point out I'm no longer the global CIO. I've actually become head of global head of ESG across the whole bank, recognizing how important it is to us. But I think there has been very strong demand. It is regionally different. I think it's becoming more sophisticated in the sense it's not about what I don't invest in, it's about what I do invest in, particularly the less liquid parts and the parts that are really going to drive the energy transition. And I see that having a very, very long runway. The growth has only just started.
Great. And Petr, if I may build on that, that strong growth that both Rick and Tracy are seeing and the sustainability linked bonds and you know, both global entities, with global customers. And I think it's a really interesting point that Tracy picked up on, that Rick had said, the difference between emerging or developed and where the different entities are. So I'm also showing my age here. I remember I was far younger when I was the Irish government's technology advisor, and my background was telecoms, as I said, and Rick mentioned GSM. I also remember when Europe led the way on mobile technology. We had Nokia, we had Ericsson, and your mobile phone would last for a week. Now you couldn't do a lot on it, but it did what it did on the tin, right? So in terms of what you're seeing now in Europe, with Europe more advanced in terms of these regulations and them now come down to the member states, what are you seeing from the market in terms of the reaction from the different entities, the banks, the investors' house? Petr, please.
I mean, so thank you. I mean, I thought it was actually interesting what I've heard today on this panel. I would make a personal remark that I think the EU is reasonably good in exporting standards in general, and that's either GSM data or hopefully sustainable finance now. Look, what I was trying to do, perhaps very clumsily in my lengthy presentation, is that we are aware about the world. I think the EU, by definition, is a very internationalist place. It's because by definition it's a collection of member states. So at the same time, we had to start somewhere. Obviously, you look at yourself first. Also, we do think that we are not too early in addressing the climate problems. So we're going forward with that, and at the same time, we are engaging with the world. That's in G20, that is in international standard setters, and we strive for convergence. And here, I actually I kind of agree with what Rick was saying on which I think, if I understood it correctly, express a fairly pragmatic vision of what convergence can be. It is probably not the same as one law, which you can do for one jurisdiction. But obviously, I can assure you that what we do want to do is indeed go to as much convergence as we can. What I would argue with Rick, but that would be from different panel or challenge Rick, would be about how some standard setters are not affected by national preferences or politics, as you say, which indeed is true. At the same time, I would need to argue that we need certain accountability to the parliaments, and so you cannot just take someone's standard and just ram it through your system, even though if you would believe that standard is fantastic, but it's just we live in democracies, so
yes,
that's always going to be something we need to handle. And then also, if I just to make advertising for us, indeed, we've heard a lot about the taxonomy, the common ground taxonomy. Indeed, for us, this is a way how to compare things first. I mean, I would want Tracy to kind of say, the word harmonization for me is a very high standard word, perhaps loaded, especially coming from the European Union, where we do harmonize our laws. What we're trying to do is to first look at what we have, China and us, and see how it looks like. I will also have to say the IPSF, where we're doing it, is not a standard setter. We probably need to change the governance of it for it to become it. But indeed, so I think that, and just to come to your last thing, Steve, yeah, I think for the emerging and developing world, that's something not only the EU, but others will need to look at. I would see some hope in how these things were already tackled in the G20. I don't think it's completely forgotten, but it's obvious that the transition targets will be different, and what will work for us cannot be just translated in some other language in a different jurisdiction. We are aware of that. I don't think we dropped the ball on that, but it is we're working on it along with all the other things we are working on internally, if you want. So, but I don't think that's forgotten. No.
Okay, and there is a lot going on under Commissioner McGuinness's leadership. So. I think that's recognized as well. Last question, we've got 3 minutes left, so if we could each take a minute on this. We have COP26 coming up in a few days. There's so much going on. There's a terrific din in the market right now. There's so many different initiatives popping up, so many different alliances, so many different targets. We're going to do this, and the hope is that obviously COP cuts through that and really serves as the next catalyst for the sustainable finance agenda. So, Petr, if I could just actually start with you in terms of the importance of COP26 to Europe's agenda, and a successful COP26 to Europe's agenda and this agenda, please, in the sustainable finance space.
well, so I mean, obviously, the COP26 is larger than sustainable finance and our issue on public-private finance taxonomies on disclosure. So that's the first thing to say. And as such, I think it is obviously a key event, and I think the European Union as a whole, I believe, is actually involved in for the COP becoming a success. Now, as far as finance is concerned, we'll be present with a number of initiatives. We have the IPSF event where we want to do an event on taxonomies, precisely with actually our colleagues from the EIB and EBRD. And that's a global taxonomy. This is where we like to handle or launch the handling of the issues you've been mentioning on how does this work for others, because it may work for you, but maybe not for others. What should we do? And we also we'll have an event on disclosures. So yeah, we are the success of the COP, and for private and public sustainable finance, we are active on under the EU pavilion. We've got 3 activities.
Great. And Tracy, just very briefly, because we're just about to run out of time, how important COP for you in terms of Standard Chartered?
So I guess time is running out, and I think some of you probably seen the reports of we already baking 1.1 degree, and we are potentially exceeding 1.5 degree by 2040. So really hope to see urgent actions and collaboration, back to your earlier points, in across governments and both public-private sector. And I think the panel mentions a lot on the importance of addressing standards and disclosure policy, but I hope to actually see more in the carbon market space. So I look to see concrete action development in the carbon market space.
Great, thank you. Rick, final word.
I think I'd like to see the 100 billion finally start flowing. And I'd like to see a universal agreement that TCFD would be adopted in the financial system at the maximum number of countries. And I think that will make a big difference.
Well, look, thank you to our panel for what I found, and I'm a sustainable finance policy Wong, so I found that fascinating. So I do want to thank Tracy, Petr, and Rick for their insights. And if I can try and sum up, which would be difficult, but I think Rick, you kind of nailed it a bit. You know, a large degree of convergence. We need more happening there. Very strong minimum standards, as you noted. Competitiveness. However, it's not a race to the bottom. If actually anything's the opposite. So we keep it fresh, keep stretching that target. And then also this is going to require robust dialogue between the different stakeholders. But fundamentally achieving that will actually unlock the increasing amounts of capital. And I think that's the key thing that we're trying to see at a global level. So I want to thank you, Rick. I want to thank you, Tracy. I want to thank you, Petr. I want to applaud Luxembourg's leadership as always on this agenda. And Judith, if I can hand back to you in the studio, please.
Thank you so much, Stephen Nolan there and his terrific panel speakers. And that almost wraps our day for today. So we kept hearing those 3 C's reappearing through our keynotes and discussions: coordination, cooperation, and capital, as much needed to underpin all the commitments that we heard to protect the climate, protect natural resources, and build back better after the pandemic. And I have a little homework for you, because the study that Luxembourg for Finance commissioned, benchmarking ESG in banking and finance, you can actually look at right where you are on the website of Luxembourg for Finance. There should be a link that takes you straight there. And just to recap the three main points: yes, there has been significant growth in ESG activity in the past 5 years, but in most sectors it's still only a fraction of the total, so there's much more work to be done. And while Europe, of course, is way ahead in most sectors, the United States and Asia are quickly catching up. And I want to give you just a few more takeaways before we wrap. So Commissioner McGuinness said very clearly in her keynote to reduce emissions by 55% until 2030 and get to net zero by 2050. She said, and I quote, "The scale of investment needed goes beyond what the public sector can provide," which is why sustainability is not a nice to have for the private sector, is a must have. And because this requires a global collaborative effort, The Commission strongly promotes convergence and ambition when it comes to sustainable finance at an international stage. And this is also why she said the International Sustainability Platform will soon publish a report on a common ground taxonomy, setting out common features in existing taxonomies by public authorities. And indeed, Finance Minister Gramegna expects further commitments in that regard to come through at the COP26 kicking off in Glasgow this coming weekend. And just like Commissioner McGuinness, he emphasized that it's very important to prevent greenwashing. But he said, of course, Europe cannot impose its taxonomy on other countries in the rest of the world. He did welcome that under President Biden, the US has rejoined the Paris Agreement and is part of the global push to take on the climate crisis. But he also acknowledged that the US, of course, and this was widely discussed also in our last panel, prefers a bottom-up approach as opposed to the top-down approach in Europe. And he's confident that, for example, with the help of the OECD, a compromise can be brokered that pertains and is useful for reaching those sustainability targets, much like it was achieved with the deal on taxation. And then, of course, as we just heard, our global panel on global convergence and fragmentation highlighted the need to take a pragmatic view. Of course, high up on the wish list, as we just heard, making TCFD standards mandatory in as many countries as possible. And I think there's already quite a good agreement at the level of the G20 and the G7 finance ministers and central bank governors. And as far as investor appetite is concerned, there's one line that particularly stuck with me, and it's not anymore about what I do not invest in, it's about what I do invest in, which takes me to a few words about our investment trends panel. This importance of a change in cultural mindset truly came through when they spoke about the crucial role of talent and diversity in the sustainable finance push. As was said, we need people in the industry who think differently and can create that change. And because sustainable finance is not just about doing something nice for the climate, it's about a fundamental overhaul of the financial sector indeed. And several trends stood out. Green bonds, of course, have expanded out into sustainability-themed bonds that may include both green and social aspects, a very interesting proposition for sub-sovereigns such as regions and communities and municipalities, and indeed attractive investments, for example, for sovereign wealth funds. We also pointed out the rise of the S in ESG in the post-COVID era, which reflects a rise in awareness on actual impact on the ground. And indeed, it was said there was a lot of stronger interest coming out of the ESG community towards outright impact investing, and that will be a topic for tomorrow. Asia was definitely highlighted as attractive for investors with its huge need for private investment to manage that transition towards climate neutrality with renewable energies, for example, with sustainability-linked bonds and loans. So to wrap it up, tomorrow, we will add another C to the three other ones, C as in clarity, because we shift the focus from the theoretical to the practical. So taxonomy, CFRD, CSRD, what does this regulatory alphabet soup coming out of the European Union actually mean for the financial sector? What is needed to track actual ESG impact on the ground and prevent greenwashing or social washing, as it were? We'll do our best to answer all these questions with another two fantastic panels and a keynote by MSCI's Head of ESG and Climate Research, Linda Elling-Lee. Plus, we'll do a deep dive into impact investing with Nicolas Adalbert, the founder of Norsken Foundation. Some of you may know him probably better as one of the brains behind the payment services provider Klarna. So that's it from us here in the studio. Join us today. Keep your eyes peeled for your emails coming through, because we sent you another fresh link for the live stream tomorrow. Thank you very much for watching. Look at that benchmarking ESG in banking and finance study on the Luxembourg for Finance website, and I shall see you again tomorrow morning, 10 a.m. Central European Summer Time. Have a great rest of your day.